Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder and editor of Intelligent Investor. Welcome to a new edition of Stocktake, our reporting season winners and losers edition. And boy, have we had some winners, and some of the losers have been absolute crackers. I've got Nick here and Gaurav to discuss all of these 5 stocks that we've got for you today, maybe 4, depending on how long this runs for. We'll see. We're going to kick things off with one of the real stinkers of reporting season with Gaurav. Gaurav.
I feel as though that's pointed and personal, John.
Well, sorry, no. It's all about fibre cement and not about your soft furnishing choices. Back in March 2025, you published a story which said, "WTF, James Hardie, a surprising acquisition changes everything." Normally, when an Australian company goes into the US and makes a massive acquisition, it takes a couple of years for things to blow up. This has taken just a couple of months. Why did this happen so quickly?
Why did it happen at all is the question we ought to be asking. And in fact, this result, I think, provided some answers for the motivation behind the deal. Because as you can tell from my headline, WTF, I was absolutely floored by this. I had previously I've got a little watch list. It's called The Bench, where I put the stocks I want to buy and the stocks that are getting close to being included on the buy list. And Hardie's was there. And within that afternoon, I had taken it off. I was very annoyed and I was angry. And you can probably tell from the tone of that article that I was seriously pissed with management, because I've always thought of Hardie's as the benchmark cyclical business. It's exactly what a buildings material company ought to be. Yeah. They've got technological advantages, investment advantages. They've got logistical advantages, distribution advantages. It is a beautifully managed business, and it's a genuine value add compared to every other product that's in the market. Yeah. So
which is why it's got 90% market share in fibre cement.
Correct. And that market share, the market share of fibre cement is actually growing strongly. So there was a long runway of dominant growth. Returns on capital in a capital-intensive industry have been over 20% for years.
Amazing. So this is where we were back in March.
Yep.
You pitched it as investors used to go to bed every night going, James Hardie is great. They're not going to screw this up. They've got a huge market share. They've got the best product. They can make incredible margins. They've been doing it for years. They're not going to do anything stupid. I can sleep soundly. And then they woke up one morning and to find that blown apart.
Yes.
So how did they blow it up?
Okay, so they made an acquisition of a decking business, and they justified this acquisition by saying the decking business is actually, it's called AZEK. The decking business is actually disrupting their industry in the same way that Hardie's is disrupting the cladding industry. They're
That's
taking
a good narrative.
It is and I think the market largely bought it as well.
Yeah.
So the way they pitched it was that we're doing the same thing with a different material. There are synergies, and maybe that's true. I gave them a little bit of the benefit of the doubt in the article. I said, look, maybe they can generate distribution synergies, using the same sales channel to sell 2 different products. Maybe there are production synergies, although I highly doubt that.
Yeah.
But even if you count all of those, the price they're paying is silly.
Well, let's put some numbers on that. That was, so you said that they are valuing AZEK at 22 times EBITDA and 40 times earnings. So it's not cheap, right?
40 times earnings. I think that forget about EBITDA. Look at the earnings number. That is a stupid price. That's probably twice what they should be paying for that business. Yeah. And they're using, and they not only did they raise capital, I think they raised some debt as well to do it. So just a remarkably dumb deal, especially when you consider that they had the playbook of what to do for the next 10 or 20 years sitting right there. The only thing that management had to do was carry on doing what they've done for the last decade, which is
why didn't
expand
they do
distribution points and expand production. And they had plans for doing all of that. They threw that playbook out and they did this. That's why I got annoyed.
Why was that?
Well, I think they saw a cyclical earnings hole coming up, and that earnings hole was proven to be a gaping nuclear bomb. I mean, it was a terrible result, and it's not entirely their fault. The industry is going through a large and looks like extended cyclical funk, and I think Hardy's knew that, and to cover up the earnings hole, they hastily arranged a purchase of a business that they thought would cover the hole. In fact, it made the hole far wider and deeper.
So the price when you got stuck into Hardy's about this acquisition in March was $38. It's now under 30.
Yeah.
We still got a sell on it, right?
Yeah, we have a sell on it. And what's going to be difficult, John, is if Hardy's gets to like $20, $21, at that point the valuation starts getting interesting. But we have to make a judgment about we trust a management that has not only made a awful capital allocation decision, but potentially trying to cover a hole in earnings, which I think is the number one sin. One of the biggest red flags I've ever found is trying to cover an earnings gap, and it always leads to bad decisions. And I think that's exactly what's happened here.
Okay, can I just ask one question about this? What kind of management incentives were there for current management at James Hardie to make an acquisition like this, which is just such a massive departure from the way they've run the business in the past? Did anything change in their incentives?
Nick, do you know the answer to that? I actually don't know.
I don't know the answer, but the the management team is American, and there was something I read that sort of they wanted to, all those rumors that they want to take this business onto the New York Stock Exchange and pretty much,
yes, that's right.
Yeah, pretty much make an American business.
Okay, so they've done a zero. Right, let's move on to Reece. Nick, tell us about Reece. It's basically the same story, right?
Yes, yeah. It is suffering like in a similar sector as well. But no, Reece was by far the worst result I covered in the reporting season. And I guess selfishly for us, it was a bit disappointing because we'd been pretty patient on Reece. We had a sell on it at $28 when it was a ridiculous 40 times earnings, despite management, saying that there was a few challenges on the horizon. And then it halved, and I was really hoping the morning of the result, and I remember chatting with you boys, that this might be our chance to buy, a quality company at a fair price. But after going through the result and then listening to the conference call, it was clear that this wasn't a buy. It was actually a sell. And I think the biggest reason was the result put into question whether Reece is actually a high quality company still. And I think it is a case of a business that was great that is probably now only good, and we have to adjust what we're willing to pay for those sorts of businesses. The biggest, I guess, disappointment or shock for me, though, was the Australian business. This has been Reece's core for, since it begun. And, it has been a really high quality business, but their operating margins were the lowest they have been in 2 decades, which is kind of crazy when you think of how much this business has grown and scaled over that period. And they mentioned a few things. One, there's competition. So TradeLink, a competitor that has been, pretty poor recently, has got new management, and they're seeing a bit more competition from them. They also mentioned JB Hi-Fi. They mentioned efficiency and productivity problems, particularly in Victoria, and getting people back to the office. So there's lots of challenges here, and the conference call was just dire. I don't know if you guys listened to it, but it was probably one of the worst conference calls I've heard, and it was a CEO that sounded genuinely concerned about the family business.
It almost was like
laughing, but
it was like a slow disintegration of an individual live in front of everyone.
Wow.
Yeah, it was. And it was.
You don't often get replays of Succession on the ASX earnings calls, but it's good to hear one. He used phrases like losing market share, structurally different, perfect storm, price taker. That's scary, man, in a business that's meant to be able to generate decent margins because of the service behind their products. To hear that is scary, I think.
Yeah, and I think the Australian challenges, and I think I mentioned the article, I think they can be solved. But the US is another story. Reece expanded there in 2018 when they bought Morsco, and Morsco was already was a turnaround story when they bought it. And during COVID, the industry had a massive boom, and Reece's margins and revenue was going up. And it sort of gave the impression that Reece was making all these operational changes, like they had done in the Australian business, that demanded a premium price for a better service. But more recently, as the industry's gone down, it's clear that there hasn't been any operational changes. It was just an industry tailwind lifted all boats, and now revenue and margins are falling away. The competition over there is just fierce, like nothing Reece has ever seen in the Australian market. So they had the owner, or the former owner of the Fortiline business, he waited out his non-compete clause and then teamed up with private equity to take that business on again. This is a 70-year-old, so and Reece made the comment that usually when we buy an Australian business, the owner just goes and sits on a beach and retires. But in in America, they go and get private equity and come back at you. And so that former owner has poached a quarter of Reece's staff, and the leader of that business, their waterworks division in the US, has also left in the last 2 months. The CEO mentioned they've lost market share in both waterworks and plumbing, and that they're a price taker. And for me, there's so many red flags there, and it's hard to know what Reece is going to do next with the US business. For the moment, they're sticking with it. They're going to keep rolling out stores, but at some point, management's got to ask, is it worth all our time and focus and energy and travel to the US when the Australian business has, got its own challenges as well? Yeah. So, it's hard to know what to make of Reece at the moment.
All right. So we had a sell on this in 2021 at $25. We had 2 further sells at $28 last year, and then another one at $26 this time last year. The share price is now more than halved, and we've still got a sell on it. That's how desperate things are at Reece. Let's move on to a success story, which has had some success in the US instead of being beaten around the head and then probably sent back with its tail between its legs. Gaurav, Lovisa, how are they faring in the horribly competitive and slightly weird United States?
Yeah, Lovisa. So the American expansion has been ongoing at Lovisa for how many years? Several years now, for quite a long time. And it comes in fits and starts. I think that's what really causes the market some problems. That's why we consistently get chances to buy Lovisa. We've had opportunities to buy it. I think we first had it at $10, $11. It got down to $2 something in the GFC, the COVID panic when we bought it again. And I think we bought it again at sort of $20 later on. So we do get chances because the store growth is not linear, and the market seems to freak out when anything doesn't go up in a straight line. But what it depends on is the availability of leases. So Lovisa management is quite disciplined in the returns they get, and the large determinant of that is the lease expense. So they're looking for these dozens of new locations, but they're looking at a particular cost that they want to hit. And if they can't hit that cost, then they just don't open stores. So you can go through a period of 2 years or so, which we've done the last 2 years, where American store growth has been slow, but it's now picked up quite rapidly again. And I think that reflects some of the what else is happening in the American economy and why lease costs are a bit lower. But the big news out of Lovisa, look, I thought the actual result was pretty mediocre. I mean, EPS growth was pretty flat. Costs were high, margins were lower. Store growth was good, and the outlook was extremely good. So the shares popped, but the actual numbers not that impressive. What I got quite excited about actually was in the conference call, an analyst asked a question about Claire's, which is one of their largest competitor. Claire's is an established legacy competitor, does almost the same thing as Lovisa, but it has about 2,700 stores around the world, mostly in the US and in Europe. Lovisa has about 1,000 stores. So it's a larger business, but it's currently in administration. And Lovisa suggested that they're looking at it and they'd love to buy at least a chunk of those stores. And it would hasten their rollout. And I thought that was really exciting because during the COVID bust, that's exactly what Lovisa did with a business called Beeline in Europe. They took about 100 and odd stores from this business Beeline. And this was a company that had failed. It was in administration. They took those stores on, converted them to Lovisa stores, and they've all become mega profitable. It was an enormous success story. And I think they can do the same thing again with Claire's. So they have an opportunity, probably a once-in-a-lifetime opportunity to sort of double that store network very quickly.
Yeah, I know that private equity's got in there and bought a few stores already, I think, but no doubt Lovisa's sniffing around. But, 50 times earnings now, it's doubled. The share price has doubled since April.
Amazing, isn't it? Yeah.
It's, I don't know.
It's expensive, but I would say for Lovisa that their growth prospects are long and consistent. So
and global.
There is still a long runway there. So it does look expensive. Look, I agree. It does look expensive. I think 5-6 years ago, I would have just said, look, just sell. It's too expensive. But I think we've learned some lessons from that strategy in the past. And when a very high quality business that has a long runway of growth and experience management is on a roll, I think the best thing to do is just sit back and stand out of their way and let them do it. Look at this again in a couple of years, and I think you'll be rewarded from here. But my goodness, it's hard. It's hard. I get it.
As somebody sold out of this a couple of weeks ago.
Sorry, I think that may be me.
A slight feeling of regret because, we've held on for this for a long time. Became quite a big part of my portfolio. So maybe I should have sold down rather than sold out. Yeah. But I'm kind of nervous that this is still a retailer and it's in quite a competitive field. And a lot of the growth is in the US, and we're seeing increasing competition in Australia as well. So it's not as if that growth runway doesn't have a few bumps in it.
Absolutely. And you're right to call out the Australian market. Australia is still the second largest market for Lovisa globally. And growth has certainly slowed, and that's because they've got a couple of new competitors, Fleur and Harley & Harper in particular.
I was just going to say, you have to marvel at what they've done, though. I was having a think about it the other day, and I can't think of too many retail concepts globally that are rolling out in Africa, Europe, Asia, America, and still opening stores in their core market, Australia. It's kind of incredible, and that's not just retailers on the ASX. I mean, globally, there's not many that can do it, and management's done an incredible job of slowing down the store count or the openings when they need to, and pausing it in some regions, and then really going putting their foot to the floor when it is working. So
I think the hallmark of Lovisa isn't so much how many stores they open; it's the discipline in the rollout process. So you've completely nailed it, Nick. The thing that's unique is most businesses in a rollout, their goal is to roll out as many as they can, as quickly as they can, to get the multiple up, to get the share price up and earn their bonuses and bugger off. But because Brett Blundy owns 40% of that business, and you go to an AGM in Lovisa and this leaves you in no doubt about who's in charge of that company. He still approves every single store in the network that gets opened. The chairman, very unusual situation. But the discipline shown by the company in pausing, in accelerating, in picking its markets, sometimes changing the structure of the stores, sometimes going in with a, what do you call it when, franchise, sometimes going with a franchise model. The flexibility is impressive. And they're opening a store basically every 3 days. So just think about the logistics involved in opening a store every 3 days and doing that
and
for the
launching
last 5
new
or 6
brands.
years.
Yeah.
And they've launched a new brand. Yeah. Like it's remarkable. I think there's not many, you don't get many of these in a lifetime. And we've stumbled on.
Are you just making me feel worse now?
I do think you'll get a chance.
My lifetime with Lovisa has been about 5 years. It's very short. Anyway, I do think we should move on. But I will say that what you said earlier, Gaurav, about the fact that this stock can get hammered quite regularly. I'm hopeful I'm going to get a chance to buy back in. I probably won't. I said that before on many, many occasions. Don't listen to me about this kind of stuff. But it's quite possible that Lovisa does go through a period where you do get a chance, another chance. It might not be at $20. It might not be at 30. Might not be at 40.
The earnings call for Lovisa are hilarious. Every earnings call is just a 40-minute dance between the analysts and management, where analysts are trying to figure out how many stores are going to open, and management just batting all those questions away. So it's great.
Okay, let's move back to Nick. Nick, this is a very dull business compared to the three that we've spoken about, or maybe it's not. Like from a share price point of view, it's been absolutely fantastic. Dicker Data, not the sort of business that you would ordinarily associate with excitement, but you're quite excited about this stock.
Yeah, no, I think you're right. This is a bit of a boring business. For those that don't know, Dicker Data is Australia's largest IT distributor. They have a bit over 30% market share, and their two largest competitors are Ignorem and Cenex, which have about 20 to 25%. So it's pretty much an oligopoly, this market. And Dicker, since they've listed on the ASX, I think it was back in 2010, they've pretty much consistently taken share. And the reason for that is mainly their focus on the small business customer. And more recently, they've been winning enterprise workers as well. But since COVID, their earnings have sort of been flat. And the reason why was, COVID, there was a lot of businesses out buying new software, buying new hardware to give to their employees so they could work from home. And that just really, was a pull forward of sales, and now Dicker looks like they've found the bottom of that and can now grow. So this report, revenue was up double digits, profit was up double digits as well, and enterprise customers really led that. And so I don't think this is a one-off, because Dicker's main focus is small and medium business customers, and management expects them to now sort of join the party and hopefully continue growing sales and profits from here. So it was probably more a relief result. I think we've covered the business for 2 years and it's sort of gone sideways, but there's now some real green shoots here. And another interesting one was they mentioned overseas expansion for the first time.
Oh, here we go again.
Yeah, there's a bit of a theme here.
Hopefully it's to Tasmania.
Yeah. No, so usually my first thought is this a bit of a red flag. But in Dicker's case, there's evidence to suggest that they can make this work. So the reason they want to go offshore is because vendors, so this is Microsoft, HP, Cisco, are asking them, we'd like to see you in other areas as well. So that's a massive positive. And I think the first area they'd target would be Southeast Asia. They already have 2 tiny offices in Singapore and the Philippines to support their Australian business. And if you've got vendors backing you, it sort of de-risks the move a little bit. Management said they were going to be pretty cautious with it, and they didn't say whether they make an acquisition or expand, just organically. In the past, Dicker's been, favoured making acquisitions though, and they've made it work in New Zealand, where they've sort of bought their way to, I think, the second highest share in the market, and that business is working. So I don't think this is necessarily a red flag, and it could be the next growth leg if they can pull it off. And that vendor support is a big tick for me.
So it's got a 5% fully franked dividend yield, which is nice at these prices. It's not expensive, 19 times earnings. So my only question is why is David Dicker, the founder and grandfather of this business, selling out? Yeah,
so he sold his remaining shares straight after the result, I think a couple of days ago. And he stepped down from CEO of the business. He was always sort of in the background and executive chairman, CEO, but didn't really have any part in the day-to-day operations. He always said, though, or what I have read, that if he did step down from chairman and CEO, he would just sell all his shares. And that's exactly what he's done. I think he's got to the...
Why, though?
Yeah, I think he's got to the stage of his life where he wants to spend some of this money. I mean, he's trying to get I think it's called Rodon, his racing team into Formula One.
No.
He spends
no.
Yeah, he spends most of his time in Dubai and a little bit in New Zealand as well. So he's been detached from the business for a while. But what I would say is this move has been flagged for a little while, and the management that is left over is excellent. So Vlad, the chief operating officer, who is essentially the CEO in Orbit in everything but title, he's been buying shares and has been really running this business for the last few years. So I'm not too worried about that, but it is a big change. David Dicker is no longer there and no longer owns any stock.
Maybe he's put it all into PWR radiators.
Nick, do you reckon that, I think the one thing that might change with his departure is the dividend policy, perhaps? Because that always seemed a bit off to me, the quarterly dividends, and arguably maybe dividends that were too high. Do you reckon that might change? Because he famously didn't take a salary, and all his compensation came from his cash compensation came from dividends. So that with him gone, you think it might be a more normalized dividend policy? Yeah,
it could be. I mean, Dicker pay quarterly dividends, and they pay all their profits out as dividends. So it's pretty much 100% payout ratio. And listening to some interviews with David Dicker, he thought that any private business or publicly listed business as well should pay all their profits out as dividends. That was, that was his opinion. And in the past, they've actually raised debt and equity to make acquisitions rather than just reduce the dividend and use cash flows. So you're right that might change, and that might disrupt the shareholder base a little bit. But I think that's missing the that's the sort of trees. Was it forest from the trees?
Yeah.
Yeah.
I can't remember franchise. You can't remember trees. Jeez.
Yeah, I know. Yeah,
but if you want to paint yourself as a growth story, which it sounds as though they're heading like a gentle growth story, I suppose, then you do have to sort of not behave like a REIT.
Yeah, I mean that's true, but I mean they've been able to fund their growth so far. So like it's not like when they listed in 2010 and they've paid out big dividends the whole way through that they haven't been able to grow. So they have been able to grow internally. Some of it has been through equity and debt, but it's not clear that the dividends have hamstrung their growth in any way.
Yeah. Okay. Thank you, Nick. That was very interesting. It's an interesting stock, and it's not getting much sort of coverage and enthusiasm at the moment, which makes it more attractive to us. Another stock that's also been, this has just been an incredible performer over the past year or so. Gaurav, it's getting on for a year since we went up to Brisbane to go and see the Auto Mile at Indooroopilly shopping centre, and I dare you guys to say that whilst looking at the name of that suburb of Brisbane, to see its shopping centre outlet where they've got a whole load of brand new vehicles, including BYDs and MGs, 2 electric vans. And then the next day we went off to a huge shed not so far from Brisbane Airport where they have their Easy Auto 123 secondhand car dealer brand, which was quite an experience and very eye-opening for us. We put AP Eagers Automotive on the buy list after that visit. How's it done over the past 12 months, and why was the result such a cracker?
Yeah, this was probably the highlight for me of reporting season. I think that's the second year in a row where Eagers has probably delivered the best result I've seen. And it really the reason it was so good was because the revenue forecast they just exceeded every expectation we could have had of that business. Over the last 2 years, they've added more than $2 billion. Over the last 18 months, they've added an extra $2 billion of revenue to a business that isn't historically growing all that much. It's a market that's pretty stagnant.
Pretty stable, yeah.
Yeah. And it's partly because of the big changes happening inside that industry. So Chinese car brands are coming into the market at a much lower price point, and so there's a lot of buyer churn out of legacy car brands into the Chinese car brands. There's that, and there's also because Eagers' dominance of the industry, they have sort of 14% market share. It allows them scale and margin expansion that no one else can manage. And just for reference, they earn about 3 times the per unit gross of their next competitor. And that's astonishing. Globally, that is unheard of. Even their used car business, I think for me, the big change, John, was I was always pretty impressed with their new car business. And I think we were very clear that the market did not understand new car business, that they had tricky accounting. It was complex to unravel. Yeah. But when you unraveled the accounting, it was clear this was not just retailing cars. This was actually a low capital intensity, high cash flow business that involved insurance, finance. It was mostly a finance business, actually.
Yeah, and there's a flywheel.
Yeah, well. and there was a flywheel. And the used car business was just such an important part of completing that flywheel, and just had so many advantages baked in. I think we're all unanimous that the market just got this one completely wrong, just did not understand it. Yeah, and I think it's understanding it now because the stock has tripled.
And does it understand it too well?
Yeah, and I look at the valuation now, and there's a lot of optimism baked in. You're seeing analysts now talking about how wonderful this business is. You know, people who didn't want to touch it at $9 now are all over it. Yeah. There's a lot of enthusiasm for the company, which is making me nervous.
And is that coming from, dare I say this, the dreaded North American expansion?
No, I don't think they haven't confirmed. Look, in conversations I've had with management, they've hinted only at a North American expansion, Canadian expansion specifically, but it's really what's happening in their Australian operation. They had guided as early as February for 12-month revenues to grow by $1 billion. They actually hit that number in 6 months. So they're going to double an already expanded guidance this year. Like they're doing numbers that really, frankly, are quite remarkable. No one had these in their forecast. I was bullish the stock. It was a huge part of my portfolio. I pushed hard to get into the funds, but I did not have anywhere near the numbers that are being printed. Nowhere near them. Yeah. I've been taken by surprise as well.
Look, I own a BYD, and I know I bought it through an Eagers outlet, and I know that you really don't like EVs from a driving perspective. I'm house sitting for a friend at the moment, and I'm driving around in a hybrid Toyota. It's just horrible. It feels like a really massive backward step compared to an electric vehicle. And I bought the cheapest BYD I could find. Is how much of this result is people buying new electric cars, or how much of it is just business as usual?
The rate of people buying hybrids and electrics is certainly rising. Hybrids is actually dominating the space. I think the growth in EVs has really slowed down. And just to be clear, I think EVs make a lot of sense for the average person. I like cars,
and for me
personally, yeah.
just so the listener knows, Gaurav likes to shut his garage door and just rev up his V6 or whatever he's got.
A V8, please.
V8, sorry.
Yeah.
He's no commoner.
Is there a chance that you might join David Dicker in Dubai at some point?
Yes. Yes. Definitely, yes. I actually wanted to take over coverage so I could go visit him. But Nick has that stock firmly in his grasp.
Okay.
Now, the gain is actually coming from the expansion of the hybrid base rather than the EV base. But I think there's something more important happening here, and that's that the average car price for non-Chinese cars actually gone up, almost doubled. It's gone up from about 38 grand to over 60 grand, itching towards 70 grand. And so there's been this opening for Chinese brands to come in at a much cheaper price point, and consumers are mopping it up. I think I saw 4 of the top 10 brands in Australia are now Chinese, which is a dramatic change from even 2 or 3 years ago. And it's Eagers who has most of the Chinese brands. They are the number 1 distributor for 13 of the top 20 brands. And what you're seeing in Eagers' numbers is you're seeing a display of dominance. You're seeing what happens when one business absolutely dominates an industry, and management has the skill to negotiate that dominance without pulling it too hard.
Are you worried about a collapse in Chinese automakers at all? No.
I'm not worried about that. I'm worried about valuation. That this business is in safe hands. I'm happy to own this for the next 20 years. I will say, for the record, I have taken a lot of my money off the table on Eagers. It was a sort of 25% position size for me. So I've scaled that right back to a more normal position size because it is looking expensive. There's not many times when Eagers has gone up sort of 25 times earnings, and and these earnings numbers aren't exactly trough numbers either. These are punchy earnings numbers on a punchy multiple. This is we've got to be careful here, but it is an outstanding business, and as we've said earlier, you don't want to be selling outstanding businesses too easily.
On that note, I think we will end there. So they are the winners and losers of reporting season, or at least some of them, some of the highlights and some of the lowlights. I hope you enjoyed that edition. We will be back in 2 weeks. Nick, Gaurav, thank you very much for your contributions. Thank you very much for your time, and we'll see you in 2 weeks.